more and more central banks are buying more and more of the government debt, basically monetizing the fiscal debt. I mean, what do you make of this? How risky is this? We're seeing it not just in Indonesia and India, we're also seeing it in the Fed, the BOJ as well.
Well, I mean, I think that all the central banks have the goal of maintaining liquidity in the credit markets for it to continue to function so that investors can really step back and take a look at relative value rather than facing, a real credit crisis that could happen if all confidence, falls away. So I think they are doing their job, and it is, needed right now. I think the question then really becomes, how do we assess the value across the regions, what's the relative value of that? I think, that's where we see a lot of value today in Asia credit markets compared to the rest of the world.
But the question really is what impact that would have on other assets as well, like currencies, for instance, before we get to your choices of where the opportunities are right now. What impact could that have on the currencies? Could it lead to a weakening of the currencies? Could it lead to perhaps inflationary pressure as well?
Well, I mean, we're really a credit shop, so we're not really focused on the macro aspects, of EM currencies. But to date, we have not seen that risk of this risk sentiment come through from the EM currency markets to negatively impact our credit markets since March. I think things have really settled down. So for us, as long as the U.S. dollar isn't strengthening too much, I think that still maintains a relatively positive backdrop for EM markets.
And Monica, the Bank of Japan, though, I mean, they're starting to buy corporate bonds. We heard from the RBI; they're indirectly doing so. They're allowing these banks to use all the money from these telcos to buy corporate debt. Do you expect more central banks here in the region to follow suit?
I think that the buying of corporate debt is it's clearly a trend around the world, right? I mean, ECB is doing it. The U.S. government, I mean, obviously the Fed has expanded corporate buying to include, fallen angels and ETFs. I think that buying corporate debt is one thing, but I think what goes in and what goes out and, what's on that list, I don't think that you can expect that buying corporate debt is going to avoid defaults. It, again, is to maintain a functioning market for corporates to be able to fundraise. But, I think that being said, relying on it alone, isn't going to do more than, keeping liquidity flowing. And we have to still assess region by region. So, for example, if you look at the Fed, buying fallen angels and so forth, despite that, the default rate in the U.S. still is expected by the street to increase, to double digits, up to 13% default rate. So that isn't going to necessarily avoid the corporate defaults. And so I think it's about looking at the sectors that are involved. In the U.S., for example, you have, energy, retail, gaming, and those guys will still be hard hit. Whereas if you look at in Asia, I think looking at our markets, the default rate is still expected to remain quite low in single digits below 5%. So I think it's really about still doing the bottoms-up work and understanding that the central banks are there, to kind of lift general sentiment.
Why are the default rates in Asia, relatively speaking, lower than what you see in the U.S.? Why is it still, you're saying could stay in those single digits right now? What are you seeing there where perhaps there's a bit more stability in this part of the world?
Well, I think what like what I was pointing out earlier with the U.S. markets, when you have a big part of the U.S. high yield market being in energy, retail, gaming, these are, the areas that are really hard hit right now with oil prices crashing and, COVID, and the U.S. just starting to talk about reopening, whereas, Asia has reopened earlier. But I mean, the other part of it is in our markets in Asia high yield, the bulk of it is in China and the bulk of that is in China high yield property space. And when you look at that segment, most of the companies have already started to come back online. For example, I was just looking at, as of last week, the week-on-week growth in sales on some of the companies we're tracking is, plus 35% to plus 70% on a week-on-week basis already. And, overall, we saw that March sales recovered already 70% of the same month-on-month period as of last year. So we are coming back to some normalization right now. And the fact that the sector exposure is different and is somewhat more protected from the demand, the consumer demand side, and not as exposed to energy certainly helps. And yet we look at our bonds, and yet our Asia bonds are paying at such a high premium above the U.S. high yield. I mean, for example, right now, single B rated bonds, Asia high yield bond single B is paying over 5.3% above similarly rated U.S. bonds. So I think, all this should be put into that context on a risk-adjusted basis.
Monica, when you talk about Chinese bonds, will Chinese bonds continue to see low volatility, better liquidity, you think? We certainly have, we went through extreme volatility in March as well. And so our markets today are much more interesting because it has all been repriced and reset after the leverage washout, as what happened with the rest of the world too. And so I think we do have relatively, it's all relative, lower volatility because of the local demand base, and that local market, it came back, buying our Asia bonds fairly quickly. So, that definitely helps. And we have, I think, a recognition that is starting to happen where we see real money coming back, fund flows are coming back, because there's a real recognition that Asia bonds really are very cheap. So, as far as, the corporate bond market for this year, we can see investor appetite, will continue to be there. The market year to date has expanded on pace with over 100 billion of issuance so far. And of that, since mid-March, which was, the worst point in our markets, over 20 billion has come to market. And we continue to see the deals very oversubscribed by multiples, and the final pricing substantially, inside the initial guidance. So I think that the appetite will still be robust, especially when this year a lot of the Asian bonds will be for redemption. So that money will have, to be reinvested as well. That does lend a certain base of stability. But, at the end of the day, the demand comes with the premium, and we certainly have very cheap markets right now. You talk about liking China high yield, but you're underweight India high yields. I mean, I'm wondering how concerned you are about Templeton, Franklin Templeton pretty much winding up its credit risk funds. What are the risks of a contagion there?
I mean, that has been broadcasted since, last week, and that definitely caused volatility and, risk-off sentiment across the U.S. dollar, Indian bonds too, although, most of their exposure is really about the local markets, the INR. But yes, there is definitely an impact across, because Indian high yield bonds, a lot of them traded down as much as 6-7 points since that came to light. So there is an impact from a technical perspective. So I think we have done well by being underweight, both in India and Indonesia high yield this year. But that said, we will always be there to reassess risk reward if India sells off enough. But yes, to date we have been underweight that side and more overweight on the China region.